I'm Larry Walther. This is principlesofaccounting.com, Chapter 14. This is the first module in Chapter 14, and it introduces the corporate form of organization, looks at some of the key features of a corporation. So let's begin by considering that a corporation is a separate legal entity, separate and apart from its owners or stockholders. It's created typically when articles of incorporation are filed with a particular governmental body in the United States. That would typically be the Secretary of State in the state in which the company is formed or incorporated. Those articles of incorporation specify the intent of the corporate entity, its purpose, its governance structure, and the state will then issue a charter which authorizes the commencement of the corporation's existence. Now, once the charter is issued, the shareholders will typically convene a preliminary meeting and pool their initial investments, usually at least some threshold amount of $1,000 or so, to breathe life into the company from a financial point of view in exchange for shares of stock in the company. Stock, the shares of stock, is the evidence of ownership in the corporation. Now, at some preliminary meeting of the incorporators, they'll adopt bylaws and elect a board of directors. The board of directors is essentially the overseeing body that then hires the officers of the company who commence with the day-to-day business affairs. Why would someone form a corporation? Well, large amounts of capital can be pooled together from many individuals and concentrated into a single entity, something one individual, a sole proprietor, or maybe just a few people that choose to form a partnership could not otherwise do. Furthermore, the mutual ownership is facilitated through a democratic process. Typically, the common stock of the company, not always, but typically is voting so that they're able to do things such as elect the board of directors who hires the officers and so forth. It gives the ownership a democratic process. Recognize that shares of stock have transferability. Typically, there may be some restrictions, but ordinarily they're fairly easily transferred. So stock becomes a liquid asset that's easily transferable. That's great for an investor who may want to be invested for a while but then be ready to move on and move the money into other things. The shares may be listed on a public stock exchange. To do that, there would be an initial public offering where a stock is offered to the public for sale for the first time. That's typically accompanied by the satisfaction of numerous regulatory requirements, including the preparation of a prospectus which details the corporate plan and the intent for utilization of funds that are raised through the initial public offering. Another advantage of a corporate form of entity is its perpetual existence. It essentially lives forever. It outlives its shareholders. If shareholders die, the company doesn't die. The shares are simply transferred to some heir of the deceased, but the company continues to exist. Now, when I say it lives forever and has perpetual existence, obviously things do come to a close. Many corporations will find that they're bought out by other companies and cease to exist. They may fail financially. They may go through some voluntary liquidation. They decide that it's no longer viable to remain in business and they choose to sell the assets and wrap up the affairs of the business. Another advantage of the corporate form of organization is limited liability. Stockholders are ordinarily liable only for the amount of their investment. The debts of the company don't extend to the shareholders. The creditors are at risk and have a claim only against the assets of the company, but not against the personal assets of the shareholders. There's exceptions there. Shareholders might sign a guarantee of corporate debt, in which case the creditors can attach the assets of the shareholders, or shareholders may make a mistake and commingle their personal or financial affairs or business affairs with those of the corporation. A court may set aside the corporate entity. It's failed to meet the conditions necessary to maintain itself as a separate legal entity. And so there are pitfalls, I should say, to this idea of limited liability, but if one's very careful with their legal structure and operating procedures, it should be possible to preserve that limited liability. A disadvantage of the corporate form of organization, at least in the United States, is this idea of double taxation. The corporation is typically a taxable entity, so it pays tax on its income. The remaining income, when it's distributed to shareholders as dividends, those dividends are ordinarily trigger a taxable event to the shareholder. So that can trigger a double taxation effect. There's relief available. Dividends paid from one corporation to another are eligible for various levels of dividends received deductions. There's certain corporate form of entities, S corporations, that can be formed and structured so that they're not taxable entities, but that the income flows through to the shareholders and is taxed to the shareholders only one time. In some countries, they provide for tax holidays. In an endeavor to attract new businesses and corporate investment in their country, they may say that for a period of 5 to 10 years, you won't pay tax on your profits. Another disadvantage of the corporate form of organization is costly regulation, particularly for public companies. There's a lot of regulation to avoid rogue corporations that cheat shareholders out of their investment money. The idea is to foster public confidence in the equity markets. In the United States, there's a Securities and Exchange Commission that heavily regulates and provides oversight of public companies and their reporting practices. Those public companies must prepare and file numerous documents, oftentimes that are audited or subject to independent verification. Furthermore, companies are required to maintain strong systems of internal control. So there's a number of checks and balances to try to preserve the integrity of the public corporation as a vehicle that is of interest to potential investors.